Hi, I'm Dan with Pay Down Debt Solutions. Welcome to our channel. You've seen our previous two videos. You don't have to, but I'll tell you what they were. They weren't numbered part one or two. They just worked out to be part one or two. Part one, I'm wearing a light green shirt. Part one, I go through just the bigger concepts of moving your money in and out of credit cards and a personal line of credit, whichever your options or choices, let's say, for your debt destroyer. And in number two, I went into kind of how you pick your order to pay debts. Today, I'm going to bring them together. So this will be a complete video, if you will. It'll have how I look at your cases, everyone's cases, regardless of how much their cash flow is, how much their income is. None of that matters to me. I'm a purist. All I want is the numbers. And I'm going to try to avoid the whole setting up a story problem for you thing, because I don't want to make it any harder than it is. Most people, this is just arithmetic. No one's going to struggle with that. You're going to struggle with applying that to the concepts of actually doing velocity banking. And Jen always wants me to do the math. We'll see if I get into the math today. I don't think she watches my videos. She just waits for positive or negative feedback. Then I'll hear about that, because we're constantly in fun competition between each other. But let's look. In the previous videos, three types of main people we see. First person, this is probably the rarest. They don't want to know. They don't want to do the math. They don't want to go search what their payment amortization schedule on their credit card repayment looks like. They don't want to do that. Just give them some rules of thumb to save the most money they can on their debts. The KISS, the keep it simple, stupid version, I respect it 100% because it's the easiest and it still saves you a lot more money than just paying down your debts the conventional way, just making payments every month, the same fixed payments every month. The second one is they'll do some research, look it up. They don't have Excel. They don't have an online calculating program. They don't want to do all the calculations by math, but they're going to do the research. They're going to do the research. They're going to save themselves a lot more money than the first person I described. Then the third person is essentially me. And I said in the last video, this is not a get rich off realty book that I'm trying to, I'm doing this for marketing for in the future, where I'm just going to leave out the most critical steps, the steps that literally make or break you, and the steps you need to know, whether it's why did I even waste $90 on this book, or I don't even know what books cost anymore. $9 on this book when they didn't even leave in, they left out all the parts I need to know before I even invest in it, whether it'll be positive or not. And I got it from a good friend of mine. He's like, yeah, my dad told me when I was a kid. He goes, I started paying attention. He was like, yeah, all these, get rich doing this books and all that. He was like, they always leave out the key details. Yeah, because they don't want competitors. That's how they got rich. They spotted that flaw. They spotted that little loophole. They're not always loopholes. But they just spotted that opportunity. That's the best word for that opportunity to become rich. They don't want to give that exactly to you. I don't know why. They wrote a book explaining to you. Anyway, I digress. So that's the third person spreadsheet. I'm going to explain to how I do it. I'll touch on a little bit of what I do as I'm doing it, not because I'm holding back, because you guys got to come up with your own. How my mind works, even if it comes up with a correct mathematical solution, my organization is not going to be the same organization. Other people are going to be more comfortable doing different things. So I want you to show you just mine. Let's do it. I'm going to give you enough that you could do it like I do it. If you don't have an idea of your own, but you'll be able to do your own without being tainted, let's say, by my way of doing it, right? So those are the three types of people. There's two situations and two factors contributing to. The two situations are whether you have zero to low cash flow each month or you have positive cash flow. And then the variables are whether you're using a credit card or a line of credit for your debt destroyer. And I'm going to try and keep this video short because we're just discussing concepts here. I'm going to condense my stories, trying to go off on too many tangents. So let's go to the first one, zero to low. Zero to low cash flow each month, right? We got three examples under this, the three types of people we described. You're zero to low cash flow. You want to save money. You don't want to do all this hassle. You got loans. You got credit cards. Start with your credit cards always. Then go to your loans. And I say always. Remember, rule of thumb. But if you're not going to go in there and do your own math, you're just going to have to trust the rule of thumb. And it's going to, for you putting in the minimal effort, it will maximize your savings. You're going to start with your credit card with the highest monthly payment, which generally that goes hand in hand. I hate saying anything absolutely because there's almost always an exception, right? That proved the rule. So you're going to go with your highest interest percent payment. Whatever that is, if it's a credit card debt destroyer, that's what you pay down. You pay that credit card off doing the velocity banking. Put your available income in, then your chargeables. And I'll get a little bit on some of the math for that. So you've got your total income, you got your total expenses. Your total expenses are chargeable expenses, non-chargeable expenses. Make up your total. Your available income equals your total income minus your non-chargeable expenses. This is where I tie it together. Even if you don't like the math, you've got to know at least the concept of this, right? Because you're going to do a credit card for your velocity banking. So what you have, right? You picked credit card 1, credit card 2, credit card 3. The order is irrelevant. You're looking for the highest payment. Highest payment. And you're going to pay them down, highest payment to lowest. Right? Period. But this part, this is as much math as you have to know. There is a minimum math. There's not zero math. Maybe there is, but not to do velocity banking. You at least have to know this, because this is why you have to know this. You got your checking account. You got your credit card you chose as your debt destroyer. Right? Credit card debt destroyer. All your paychecks come in here. Right? Weekly, bi-weekly, monthly. If you're already paying ahead of your bills, the timing is irrelevant because you're already making your payments because you're at zero to low. You're not upside down. You're zero to low. Your money goes into your checking account. Only your available income. And if you have to split it up, you decide how you split up. And you decide how you split it up, meaning, say your available income's $2,000. You're getting paid bi-weekly, so it's $1,000 each paycheck. Well, that seems logical, but if your mortgage is $1,100 and it's due only during the period you have your first paycheck before your second one comes in, you can't just do $1,000. You have to do at least $1,100. So you split your available income across paychecks as you need to pay bills. If you got paid once a month, it'd be easy. Well, my check came in. I took all my available income, my total income minus my non-chargeable expenses. Right? I just put it all in there. If you got to split it up by paychecks, you might not necessarily be able to split it up equally. Right? You got to be careful of that. But however you do your split based on what bills are coming out before your next paycheck, you take your available income, you put it on your credit card. And then now you're going to have chargeable expenses. Chargeable expense 1, chargeable expense 2, chargeable expense 3. Very easy. So it was maxed, right? Your available income, excuse me, this is the main math you have to do. In order to be sure it will work, your available income has to be greater than your interest and your expenses that are going on your credit card. We call it the differential. There has to be a differential. So your AI has to be greater than your chargeable expenses and your credit card interest. If you don't have that, you cannot velocity bank. Whatever you pick as your debt destroyer, the debt will go up faster. Basically, you're paying it down just very, very slowly by even just making your minimum payment. You're paying it down just very slowly. But if you do not have this, if your available income is not greater than your chargeable expenses plus your credit card interest, you are not paying your credit card down. You cannot do velocity banking. That is number one. Know what your total income is, your expenses, split up. Now, your chargeable expenses aren't how you're currently paying them. It's what you can charge. So you have to look at each bill. What can I charge? What can't I charge? Mortgage, rent, loans, almost always non-chargeable expenses. You got to look at your utilities, maybe insurance, things like that to know for sure which ones these are. Then from that, you can calculate your available income. Now you got to make sure your available income is greater than your chargeable expense total and your credit card interest for that month. Because think about it, if you're putting available income's $1,000, and you're putting $1,000 on it, but your chargeable expenses are, $990. Well, you got that's $10. Yeah, but your interest every month is $45. You're running up. You're not paying anything down. You're actually running up your credit card. which is what you're exactly trying to do. This is the extent of the math you got to do. This is the broad strokes. Excuse me, 0 to low cash flow. You don't want to do the math. You want broad strokes. That's the minimum math you have to know. And then this is how you do it. This is how you apply it. All your paychecks go into your checking. You take your available income, you put it onto your credit card. Then as each chargeable expense comes due, you take it out and you pay it. Whatever days of the month they're coming out. And like I said before, you just got to be careful. Your available income might, if it's weekly checks or bi-weekly checks, you might not be able to do it even, like, oh, just split it 50%. The early check each month might have to be 70% because of the bills that are coming due for your next check. Once you pay your credit card down, it gives you some flexibility. But if you're starting a credit card very near the limit, you have to be careful because you don't want to overcharge. You might just get denied. My cards always had a grace period, but then they just shut off. Like, it wasn't like a good grace period. They just let me go a little bit over the limit. But once they shut off, I had to go all the way back under the limit before I could use them again. Doesn't let you work in that little above limit area. Mine didn't anyway. Right? So this is how you're doing it. This is 0 to low cash flow. You don't want to get into any numbers. You don't want to do any research. This is what it looks like. This is the bare minimum you have to know, in which you already know your income. You probably already know what your expenses are every month. But for a lot of people, it's an eye-opener when they actually list out how much, like, they had no idea. Like, oh my gosh, I'm spending $25 a day stopping at the gas station for some drinks and snacks. Like going to work and coming home from work with a long commute. Yeah, a lot of people we just happen to get like 3 or 4 in a row. They're like shocked. They're like, I can't believe how much I spend in food every month. Might be eye-opening for you, but this is your minimum math, right? So now we're going to go up a level. Actually, we're not going to go up a level. We're going to do line of credit. 0 to low cash flow. Highest payment is loan payment with your credit cards. Then you attack your loans. Just a little easier. Well, to me, it's a lot easier, but setting this up it's just like doing velocity banking is just like a loan. It's front end loaded, not with interest, with effort, right? So now you got a line of credit. I always say personal line of credit. It just rolls off the tongue for me. So here's your personal line of credit. Here's your debt destroyer, right? You didn't do any of the math. You don't even have to do you have to do this math? You still got to do this math. What you don't need is this line. When it's a personal line of credit, you don't need that. And you don't need those. You need total income, total expenses. Because you don't have to split them up. Boy, I'm having a day, aren't I? Goodness. Erasers everywhere, markers everywhere. Okay. So you don't have to split it up because now you're doing a line of credit. And I'll show you why when I get into moving the actual money. So you just need to know your total income, your total expenses. And as long as your total income minus your total expenses, right, is greater than the interest charged on that line of credit, you can do velocity banking, right? As long as that difference is greater than the interest, you will be paying down your line of credit. And I didn't cover it on the credit card. The credit card will tell you how much interest it's calculating each month. You can look at the math online, but you're not going to do the math. That's right. The first person they don't want to do any math. The second person will be able to do that. They'll be able to look up their credit, check their credit card statement, right? Because they don't have a problem with the math. They just can't do all the calculations. I don't even do it by hand anymore. I had a program created to do it for me, so I can get through cases faster. But as long as you got that, because when you have a personal line of credit, all your income goes right into that line of credit. As soon as a check comes in, transfer it. Weekly, bi-weekly, monthly, whatever it is, transfer it right into your personal line of credit as your debt destroyer. Because you're not actually paying anything directly with your personal line of credit. Some people can. There are cases where you can. But the average person isn't. Because what you're going to have down here now I'm not going to write chargeable expenses, write bill. Bill 1, Bill 2, Bill 3, Bill 4. Right? You're going to put your full income on into that line of credit. Now, don't get caught in the concept of line of credit. Line of credit, when it shows a dollar amount, depending on the bank, shows you the money available on it. And we just ran into this, and I covered it before. Now it's been a few weeks. But the home screen, when you see all your accounts, shows a dollar amount. That was our balance owed. But then when you clicked in it, it showed how much balance available on it. So I got a frantic call from Jen, like, what'd you put on the thing? It's way higher. Well, flipped it. We had like $8,000 owed to pay, to pay it. But when you flipped it, it was like $17,000 because it's a $25,000 limit. So she logged in. She's like, how'd $17,000 get on the card? I'm like, wait a minute. I know I didn't do anything, and I just checked it yesterday. So I was like, well, fraud can happen in 24 hours, right? So anyway, total income goes on there every time. Put it in. When you have a bill due, you take out just that amount. So we'll say equal to bill 1. You take that amount, pay it however you're paying it. Auto pay. Bank send a paper check. You write a check. Whatever it is, you pay bill 1. Same thing. Anytime a check comes in, the whole check goes in your personal line of credit. Bill 2 comes due. Well, you take that money, that equal is to bill 2. And you pay bill 2, however you're paying it before. That's why it's easier. You don't have to worry about all that. Hey, I got to do the math. Oh, what's my non-chargeables? Oh, my rent got increased, or oh, hey, my insurance changed. All that, that's why line of credit's easier. It's only that step. All your checks come in, you immediately put them in your line of credit. You put them back to your checking just to make each payment as it comes due. That way that money sits in there and saves you interest instead of making the bank interest. All right, so now we're still zero to low cash flow. This is some people doing some of the math, and they're still going. Now, this was for the previous person who didn't want to do any math. This is how this concept, the personal line of credit, happens for anyone. This is for everyone. These over here, the credit card, debt destroyer, this example is for everyone regardless of income. But now, what's going to change now is you're still zero to low cash flow, but these people, they're going to do the research. They're going to look up maybe tables, and they're not going to put them in an Excel sheet. What they're going to look at is they're going to go, oh, credit card one I'm making a $100 payment on, but keep that payment fixed. They're just going to write down what calculator.net spits out. And it's going to say 36 months to pay off, $10,000 in interest, right? And it'll also give them right now, the amortization table will be available to them. It'll give them their split, their interest and principal, how it's split up on each payment. And it's going to be for each card, right? They don't have to copy and paste all that. What they're going to look at is when it's a credit card, right? So let's ignore the line of credit over here. When you're using a credit card as a debt destroyer, they're going to tackle the one with the highest interest net monthly payment. Because I can't save you the principal, right? You buy a $100 sweater, it costs you $100 one way or another. But I can help you save on the interest you're going to pay for that charge going onto your credit card. So you're going to pick the first credit card you pay off, be on with the highest percentage of whatever the total interest is. I keep saying percentage. So if you got a split here, you say you're paying $200 on each credit card, but they got different balances and different interest rates. Well, if this one's got 170 going to interest and 30 going to principal, right? $200 payment, but this one's got 180 going to interest, only 20 going to principal. I said say they have the same balance, but say that you got the same payment. This is a $50,000, this is a $30,000, but this one has a lower interest rate. So because it's lower interest, more is going to the principal of each payment. You're going to pay this one off because it's going to immediately start saving. That first month alone, it saves you $180. And when you look at the table, you'll see it. You'll see it playing out. But look at the first, let's say, just look at the first 12 months, right? So you get all these on your spreadsheet now. I'm sorry, we're not to the spreadsheet yet. These are the people just looking at the math. This is all you're going to have to write down. You don't need this. I wrote that like I was already thinking of the spreadsheets. But it's going to, this card will split out the same thing. How many months, total interest you'll pay, keeping your payment fixed for all three. That's good information. That's information you'll use in, let's say, phase 2 of your pay down strategy, using velocity banking. You're going to go with the one that has the highest percentage of interest. Immediately start saving, right? Your zero to low cash flow. You want the fastest increase in positive cash flow, and also because the faster you increase your positive cash flow, the faster you're going to pay down your remaining debts, moving forward through all your debts, right? So that's what you're going to look at. Calculator.net is not my favorite. I use Piggly a lot too. I use Piggly just simply because when I use Excel, It's easier to copy and put Piggly into a spreadsheet. It comes out nicer. I have to do less manipulation to make it readable, really. So that's it. This is your comfortable. You're like, well, I want to really maximize my savings. Look up each card. When it's a credit card, they need to know your current payment, your interest rate, and your balance. And it'll spit out a schedule for you. But it'll also give you lumps. Total months to pay off and interest. And then your loans are later. Because you're zero to low, you're going to go through your credit cards first, but this will help you with the order of them. Get through your credit cards, then you can start chunking down loans. And this is using your credit card as a debt destroyer. But if you're comfortable doing some math, some research, and you have a personal line of credit, what does that change? Your first step, still pick that highest interest one. Get yourself positive cash flow immediately and start and pay that debt down, the big one, that big payment, that big interest payment, I should say, faster. Excuse me, allergies are kicking my butt. But when you have a line of credit, you're chunking these things down. Your velocity banking inside your line of credit, but you're chunking these down. So what you're going to want to look at is, hey, and I think it's calculator.net. You pick one of their loan payoffs or credit card payoff calculators. You go in there and say, oh, make your payments. They'll say, okay, what if I do a one-time chunk? One-time payment. Well, that's what your PLOC's going to look like. So say it's $5,000. You've got each of these examples. And what I would recommend is on your computer or your phone, open an individual browser window for each one. Each one goes to calculator.net. Because otherwise you enter the data, you lose the data of the other stuff. It becomes a whole rigmarole of where do I write my notes down, blah, blah, blah. So you're going to look at credit card one, right? This is a PLOC with a big chunk. You're going to plug in that calculator. Now you're going to go, well, here's my payments, and it's 36 months, $10,000. What if I make a $5,000 payment? How's that? What's my interest go down? Unless you're on a time constraint because of retirement or moving or something, just worry about your interest. So like, all right, I make that $5,000 one-time lump sum. How much does my interest change? And do it for each one. Excuse me. Now loans, your loans could have a smaller monthly payment, but if they're going out like a mortgage, 360 months, chances are your loan will save you more interest. But you can't look at the loan early on because you're still at zero to low cash flow. You got to get some cash flow moving to pay everything down faster. If you switch with the loan, you're still going to be stuck. You're going to be paying your debt free. Let's say your lifestyle is not going to be improving. Your actual life's not going to be improving because you're still strapped. Go after that. Improve your situation. Get your positive cash flow up. Go through. When you start getting your positive cash flow, that's what you're going to look at. And they have the same thing. But for a loan, you need more information. A loan, you need your original loan amount, your current balance, the interest rate, I believe number of payments remaining. Yes. Yeah, that's what you need. And if I didn't say it, I said current payment, right? And your current payment, they'll pump out an amortization, so you'll see. Because what you're looking at is, we always tell yourself, you are not a small business. You have to think of yourself as a small bank. Move your money around, and it sucks because you're already grinding, you're already working. Like, one more thing I got to do. It's not making you money. It is in a sense, but it's like depreciation, a non-cash expense. You're saving the money. You really are. It's a 100%. It's not 100%. You are guaranteed. There it is. A guaranteed return on your investment. Doing the pay down strategy, velocity banking, taking that chunk out of personal line of credit. You're going to plug it in and go one-time payment $5K. How much does this go down? One-time payment $5K. How much does this go down? One-time payment $5K. How much does this card go down? And interest that will be paid until that debt's gone. You're investing in your savings. You're going to take that $5K, and the next thing you pay off after you started with the highest payment. Sometimes you might have to do two cards, like get rid of your highest payment, your second highest payment. From then on, then you look at, if I got that chunk, where does that chunk save me the most interest? Because now that's your investment. I invest $5K into saving on interest. What's my return? Put it where your greatest return is. And I did this line like it was an Excel sheet, because the Excel sheet, you can just go back and reference it. But when you're just doing this, searching one individually, That's what you do. Like, boom, this is to get started. Hey, credit card's paid off. Look at them again. Now, you're not going to have to look at every single one because you're going to have an idea on some of the others. And you might have written down your original notes. You know, this month's this interest. Well, you know, look at your next two biggest payments, let's say. Compare those, because it's never going to jump ahead. You're not going to be like, you know, you write all these down and let's see, you organize them in greatest to least payment or greatest to least, you know, interest portion of each payment. They'll move. I've never had one move 3 spots, but I've had them where they swap. I've had quite a few swaps just because of based on where you're at. So when you go 12 months forward, you're going to do this again. It's not 12 months. But in 12 months, everything's going to change. Your balances will all be different. So once you're ready to make another chunk, you do it again. You obviously don't have to do the one you just paid off, right? Darn, that one's gone. So it's going to be between credit card 2 and 3. But remember, you're not here in the beginning anymore. You've progressed. So now your current balance, let's presume it's the same fixed payment, and your interest rate, it's going to spit the same numbers out again. Boom, boom. And you're going to go, hey, I got another $5,000. Boom, where do I get my greatest return? If I'm putting out $5,000 of my money, and I'm grinding to do velocity banking and created a headache to fix a bigger headache, a small headache to fix that big headache, where am I getting the biggest bang? Now, when it's an Excel spreadsheet, that's when you see this line. I'll take these. I had one. Actually, I got one I got to do today. It's like 17 credit cards, almost as many mortgages, business, property investment, renting, or something like that. I do this as far out as it goes. And then I look at the same thing, total interest. But when I put these in Excel, I put the total interest right at the top. I actually will sum up the interest payment column, sum at the bottom, then I'll move it at the top. So anything I do in here immediately reflects and I can see my savings. That's mainly because I don't want to go back to calculator.net. I go through it all and Piggly and some other payoff sites to verify everything, on all their credit cards and loans, how the splits are and the estimated payoff and cost. You're going to go, and what you're going to do is, let's say you pick credit card 1, right? Boom. Well, you hit 12 months, right? So now we're here at 12 months. What I do is I go on the left side of the screen, I do a bottom bar. Like say you're adding it up like a line underneath some numbers you're adding. I'll do a bar across. And then I just scroll. I just scroll across and go, okay, what's my current split here? What's my current split here? 12 months in, what's my current split here? And what I'll do is I'll take this whole column of here, this whole interest column, and I won't delete it. So you delete, like you're testing. You want to figure out where to put your money next. I'll do is I'll pull it over into a blank column, and that amount you took out reduces your interest that much. And I'll go, okay, so this stuff's all gone, right? Like this is the one I paid off, but this one, well, we're 12 months in. I already paid that interest, so I'll take those 12 cells and move them over here, and I'll take those 12 cells there, and I'm like, what's my outstanding interest now? So now, at this 12-month mark, I got $5,000 again. Where's it going to save me the most interest? Where's it going to put it ahead? And I go the step further. I don't just go 12 months, oh, this is where it's currently at, because I want to know really what's it add up to. So if I say it's $5,000, I'll go, well, what's my balance here? And I'll go down here. So let's say this is 10,000. Well, I started with 10. Let's say it's 8,000, right? I got to go down to the principal column when it's 3,000. I will add up this interest column, right? And that's moving $5,000 over here. That's how much interest I'll save. And I'll do it here and here, and I'll do it across the whole board. There's no secrets. I'm not hiding anything. That is what I do. And I do it very slowly and very methodically. And I'm doing this on Excel, and I'm making hand notes. So if I accidentally delete something on Excel, I don't put auto save on because there's some mistakes I make I don't want to auto save. You get in the habit. You just learn to save every few minutes, right? But then I make hand notes of my order, and I make hand notes of how things change. What happens is when I pay this off, my total income's not changing, but my total expenses just went down. So I make a note of that. 12 months, credit card 1 paid off, total expenses. I actually do an arrow. I'll go, this is how I write it for students when I do cases. I go total expenses, drops $200, right? So then it equals whatever, let's say it started at, 8,000. Well, total expenses dropped 200, now it's 7,800. So I keep my hand notes. That way I know, because I've had times where it'll be like 201 and I'll accidentally write down 210. And I don't catch it. I do like 3 or 4 more cards. I'm like, wait a minute. Because I'm simultaneously running through a program I had created for our use, to automate some of this. I go, wait, the program says it's different. I'm like, oh, where did I make the mistake? Well, I got a hard copy. I don't have to wonder if I deleted or where did I, double click a cell to see where all the pluses come to add up all those boxes. It's like, no, I just go back to my notes. And I go, okay, I just got to repeat that step because I screwed up and put the 1 in the wrong spot. That's it, 0 to low cash flow. Both concepts, credit card, personal line of credit. Positive cash flow, you tweak it. You don't have to change it much. But basically, you kind of skip the first step because you already have a positive cash flow. You're going to skip the first step of, just go after the biggest payment. No, now you're going to go after positive cash flow, the credit card. You're going to go just on the same thing. Sorry, the first step's always the same. First step's the biggest interest payment each month. Not the biggest total payment, but the biggest interest payment to immediately start saving. But after step 1, like I said in this example, for people kind of do some math, willing to do some research, you do that once, you do that twice. Not necessarily, you don't have to do it twice. That's a rule of thumb. But you got to look at it and start. If you go through 1, you'll have a feel. When you get to 2, you'll be like, okay, I put 5 on 2, 5K on 2. Where's it going to put me? Or should I, if it's a credit card, should I make that my debt destroyer? Should I keep my current debt destroyer? How much do I save? You guys are going to be able to do that. And you're going to be able to do it just with the information you're going to find like in calculator.net. Because you remember, your debt destroyer is a credit card. It's going to tell you. You're going to, you'll be able to, you won't have to do it. You can just go use your calculator.net and just take your current interest and current balance. Like, I raised my balance. So what's my payment? What's my interest change on that? And you'll be able to compare it going out. Right? I know that's a little wishy-washy, but that's where it's hard to do. It's hard to do that without really getting in, like really looking at the numbers. But remember, you can always default. I'm just going to, I don't want to get into it. I'm busy. Not even busy. It's summer. I just want to be outside. I don't want to do this stuff. Just pick your next highest payment. Boom. Start doing that one. Right? So 0 to low cash flow. 0 to low cash flow. We looked at using, personal line of credit or a credit card for the 3 main types of people we deal with. Right? So now we're going to go positive cash flow. Positive cash flow, I look at strictly what saves them the most interest. They're already doing okay. They have a positive cash flow. They're not hurting. They don't have to do like the paycheck example. You get paid weekly. Those four Friday months are tight, and that 5 Friday month, you feel great. If you got a positive cash flow, you're already ahead of the curve on that. So how do I look at something with positive cash flow? Well, I look at it the same way, whether it's a credit card or a line of credit. How they handle it is different. But if you got a positive cash flow and you don't want to do the math, you don't want to do any math, same thing applies. Start with your biggest payment, work your way down. If you're the other type of person, you're going to do the research. You do that research, like I said, and you're going to keep those notes. But you're going to look up each credit card, right? And each loan. Because you're already at a positive. So you're basically, with a positive cash flow, you're not necessarily hurting, but it's more of taking a positive approach to your finances, a proactive approach to your finances. You want to pay them down faster, but you want to maximize savings. You don't want to screw around. Screw around meaning waste time, right? So for these, this is you just going online, doing some research, calculator.net, Piggly, etc. All you're going to look at on these, what you got to look at on these is if you're using a credit card as your debt destroyer, biggest payments first. Well, not biggest payment. Biggest payment, you start with your biggest payment, biggest credit card payment, the most interest, and you're working through that, right? Just like I said in the previous example, but now you got positive cash flow. And you don't want to get into the math, so you just look at, print those amortizations or the splits, or you just go to each credit card statement. It'll tell you, whatever your minimum is, this percent is, say it's interest plus 1% of principal, interest plus 2% of principal. So you're always going to know. So you're going to attack the highest interest. You work your way through the highest interest. Then when you get through your credit cards now, and you're still using credit cards as a debt destroyer, and you move to your loans, so now you're going to have balance transfer fees. Whether you go through like PayPal or something like that, to where you take a charge, you put a charge on there, and then you have them send a paper check, or a paper check to you, and you pay it. On your loans, you're strictly going to look at saving the most interest. You got through your credit cards, you went high to low, highest interest each month to lowest interest expense to you each month. Because you got a positive cash flow, you just simply have to go with the highest payment, go with absolutely the highest interest. That's the only thing that can kind of go back and forth. Zero to low cash flow, you pick the highest payment, period. You got to increase your cash flow. When you have positive cash flow, you can pick your highest payment, but generally you're going to pick the highest interest you're paying each month, and do pay your cards off in the order of highest interest each month, because that's what we're trying to save you, interest. When you go through loans, because you can only chunk them and you're using a credit card, if you do balance transfers, what you'll look at is if it's, I pick 5,000. So if it's 5,000, right? 5,000, say it's 3%, $150. It's going to cost you $150 to transfer. That's equal across all three. Just know that, don't ever forget it costs you 3%. Because all of them are going to be it's going to be $5,000 or not, that fee applies to all of them. You don't have to calculate with the fee. It's the same. It's equal across all three. Just look at total interest savings. Same thing, calculator.net, plug in all your loan information, or make a one-time chunk right now. How much did it change in that total interest cost? That's all you want to see. And you pay them off, whatever pays you the most interest. Now, with a credit card, if it's Excel, it's the same thing, just in greater detail. You can just do the amortization schedules all the way out. So I stack them to fit them all on the board, but in Excel, you're going to do them across the board. You're going to be able to check each one. You're doing a credit card as a debt destroyer, you'll check the effect of each one. Each balance transfer, because if this card's got a little less than this one, how much interest is left versus the balance transfer fee. That's how you're going to decide the hierarchy of your credit cards. When it's Excel and you go all the way out there, positive cash flow. Well, you can't just write positive. That's obscure. Positive cash flow. Right? Positive cash flow. Pay them off. After you pick your debt destroyer, the first balance you transfer over, whatever is going to save you the most interest, boom, 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 all the way down the line. It's true with a credit card, but you have to take into account, there's a balance transfer. Like, should I pay off, credit card 3's got less of a balance. Right now, I have some room, I could pay that off, but I got balance transfer. Versus if I put it on credit card 2, where's that one in that amortization schedule? How much interest is that going to cost me? Plus the balance transfer. That's when the balance transfer. Down in loans, when you're chunking with a loan or on loans, it's the same balance transfer. You got $5,000 available on your credit card or on your PLOC. Well, the PLOC, there's no balance transfer, but on your credit card, the same thing. You basically ignore the balance transfer because you're chunking $5,000. So that's the cash advance fees, the same regardless of which thing you put $5,000 on. But when you're in the credit cards, you're going to have different payoffs. So you're going to want to pay attention to that. You're going to take whatever interest you're saving over here in the interest column. Then you got to subtract the balance transfer fee based on that chunk. And it's not, hey, I got $5,000 available on my credit card, so you got $5,000 available here, but then you got $3,800 there, $4,900 there. What's the interest? What's your fees? Because based on where they're at to the final balance. That's it for that. So now, that's using calculator.net. That's using Excel. You got a positive cash flow. When it's a line of credit, positive cash flow, line of credit. I don't say these are the best. These aren't the best. These are the best because they're the easiest for me. Right? Just going to keep dropping stuff and kicking it over there. So now you got a line of credit as your debt destroyer. And you already have a positive cash flow. So you're already covering all your bills. Pay them down faster. Pay them off with less interest. I'll use an example I just did for someone. He had 2 personal credit cards, personal line of credit. His personal was the easy side because he also owned a successful small company. And it was easy because the balance available on his personal line of credit exceeded the 2 balances on his credit card. So step 1 was pay those 2 credit cards off immediately, move them onto your line of credit that's nearly half or almost a little less than, a little less than half of the interest on either of those credit cards. So you immediately cut your interest cost in half on those. And because it's a line of credit, all he's got to do is put his total income on and take money out of his line of credit back to his checking as each bill comes due, and just pay each bill. And like I said, he started his own business. When I say a small business, he doesn't own a job. He actually owns a company. He's got like multiple employees and equipment. So that's what we looked at. Line of credit, that's how he did his personal. His business was 3 credit cards. I think it was 7 loans. 1 loan was over $1 million. And what made it interesting for me was he wanted to retire in 8 years. Could it be done? And we always tell people, we don't charge, if you send us sheets and stuff, we don't charge anything unless we can help you. You don't have to pay us for a consultation like, hey, look at my numbers. Well, Velocity Banking, no, we just do that. That's just how we are. We just do that. If you actually want to go through the meeting, we walk you through it, that's an actual coaching call. But just sending us your information to find out if it's even doable is free. So, positive cash flow, line of credit. And you're good at Excel, right? So what do you look at? For him, he had all these credit cards. Credit card 1, 2, 3. Then he had loans, 1 through 7. His business was essentially set up as a zero, let's say he had 0 cash flow. Obviously, he's got revenue in, he's got expenses out, he pays himself out of the business, etc. But every dollar was essentially accounted for because the money he didn't spend running the business or taking a salary had to be saved because it was semi-seasonal. His busiest season was the warm 6 months. As slow as the 6 cold months. And no, it's not a landscaping company. Good guess, though. So that would have been an obvious guess. Or the most obvious guess. So if you didn't come up with that one, I've been like, are you even trying? Anyway. So for him, he had all this stuff. He also had some cash assets available that he was already in the process of selling. So he's like, hey, I also have this cash. My examples didn't have any cash assets, but it doesn't matter. It just makes it faster. The concept is the same. You are a small bank. Remember that. You don't want to put any more work into it. You're already grinding. You're already working hard enough like we all are these days. These days, every day, for everyone, it seems in history. You're grinding, right? You're paying. You don't want to this is it. Just set it up. Do that hard front-end loaded work of Velocity Banking. Get into the system, and then it's literally like, as much as it sucks, spending 5 minutes on something always sucks when it's 5 minutes you have to spend on it. Because then it feels like you're finding time, whereas everyone blows 5 minutes here and they're doing nothing. Looking at their phone. Get over that tiny little hump, and you are rolling. You're not just rolling, you're steamrolling the interest you're going to owe, and you're keeping it in your own pocket, treating yourself like a small business. Get back to him. So for him, he had all this stuff. Let's pick, his loan was $1 million. Close enough, right? So he had a $1 million loan, and he had $400,000 in available cash to pay it down. So now he had a loan for $250,000, he had a loan for $225,000, he had a loan for over $1 million. So what I look at, I took that $400,000, went right to the big loan. Essentially, he's zero cash flow, but technically he's positive. But that positive cash flow has to be saved year round to get through those 6 lean months. So he is positive, but I treat him like zero cash flow. Because as far as the accounting is, he is zero cash flow. That money's got to be there. It's got to be saved there. He took out a HELOC. It was a good HELOC, over $100K. So he's paying in chunks. Same principle to the HELOC, but I started with this $400K. I looked at every combination I could think of. 2 biggest credit cards, he pays those off. How much interest does he save? Because you're investing your money, your hard-earned money, whether it's you got an asset, cash, or whether it's your monthly paycheck. Where do I put that money to get the greatest return? And the beauty is it's guaranteed return. You spend 10 grand on your credit card, the interest you save on that credit card is guaranteed. Because you stop that money paying that 10 grand, you stopped 10 grand from earning interest against you. So you saved it. Unfortunately, it's not like that warm, fuzzy feeling, 10 grand your savings account would do for you. Or let's say it's 2,000 in interest. The 2,000 in your account does, but you are saving it. And I'll get to the bonus where that bonus comes in, how fast you can rebuild things at the very end of the video, if I remember, right? So what I do, I go 400,000. I went, well, he paid 1 and 2. He saved 180,000 interest here. He saved 280. So we put 400, he saved 280 there. All right. Now paying those two increases his cash flow. Paying those off immediately increases his cash flow. But I also just took the 400K and put it on the million. Because that $1 million loan, by the time it's paid off, it was going to be like, I think 674,000 in interest, something like that, 600 something in interest. But if I put 400,000 on the loan, he saved, that's right, it was 300,000. So I put 400,000 on the loan where he's at in his payments. He'd save 300,000, biggest bang for his buck. But the problem is, he's at zero, I have to treat him at zero cash flow, and he's still got the same loan payment. He just paid that loan he paid 40% of that loan off. Your loan payment doesn't change. You're just going to have less total payments you make. Right? So, to make it all work, we took the 400,000, we paid off, not necessarily credit card 1, 2, but his 2 biggest credit cards immediately. That 400,000 saved him, what did I say, 200 some thousand, right? But it increased, those 2 combined for approximately $7,000 in monthly payments. Well, now we're rolling, because now we can take his available income, which is basically all the dollars in his business that weren't directly, you call it EBITDA, and that's your operating revenue minus your operating costs. He still has taxes, pays himself out of that, pays him everything. We take that lump sum and we put that whole thing into his HELOC. And we started chunking down that $1 million loan. All we did was chunk it down. And it was like actually a $140,000 HELOC. Put $140,000 on it at a time. Right? We're chunking down that loan. And remember, he's got 6 other loans. He's got 3 credit cards. That is what's, one, going to keep him from retiring in 8 years. I know I said it right earlier. 8 years. Right? That loan had over 300 payments left on it. So over 30 years. And all that interest. But that loan was going to keep him from being able to retire. And, of course, it's huge. It also would save him the most interest. So, first I looked at it as like an investor. This is, get yourself in this frame of mind. I'm not just paying and paying and paying and paying. I want to pay where I get the greatest guaranteed return for my dollar. You put money in the stock market, that's no guaranteed return. You pay your debt down, that's a guaranteed savings on your interest. And you can look it up and calculate it, plug it into a calculator online, and it'll tell you, making that lump sum. So that's what we looked at. Put 400,000 on these 2, it saved him roughly $250,000. Oh, he saved more. Remember, he saved more putting the 400,000 on the $1 million loan, but it didn't increase his cash flow or anything. It was going to take him like way past his retirement point. So he took 400,000, paid off those 2, increased that cash flow 7,000 a month. Not 7,000 is paying down this. It's not going directly to his big loan. It's paying this off. So now, and this is what this is going to hint at the end. I'll tell you, some of the advantages, the unexpected but guaranteed advantages once you get through all your debt. So 140,000, and I got a program, so I can calculate. Well, 140,000, whatever my positive cash flow is, boom. So my calculator tells me 10 months, $4,800 interest. That's what it costs. I'm ballparking. It's very close though. If I put 140,000, my HELOC, I take 140,000, the total amount on my HELOC, put it on that $1 million. Based on his cash flow, his total income in, his total expenses out for the business, of the available income, right? We can't do every dollar of the business. He's got employees to pay. He's got payroll to make. But I know every $140,000 chunk in his line of credit is going to take 10 months, $4,800 in interest. So what's he actually save? Well, this is a loan. This is a real amortization schedule. So when you do that for a real loan, and you want to look at this yourself, remember the first person, they're just the first type of person. They don't want to do the math. All they're doing is paying off biggest to lowest. Start with the credit cards, then work on the loans. The people that get into it, they're going to look at this, and they're going to see the people who are okay with doing some research, some math, but they're not going to do endless arithmetic, which even I don't use Excel, right? They're going to look at, well, they're going to plug these into their calculator, .net, Piggly, whatever. They're going to go, well, I put 400,000 here. In this case, it was like, say, 200,000 here, 180,000 here, 220,000 there, right? What's that change? Well, boom. Well, you pay these off, you know what it changed. You plug those in calculator, like, well, I just put 200 there. All right, look, I saved all the interest. So you're basically calculating your savings to look at your greatest return on your dollar. Dollar investment into yourself. You're going to saving yourself interest. Then you're going to do the 140. You're going to plug this loan in and go, well, I do 140K now. What's that do? What's that change? The way I do it when it's that nice big Excel sheet is I do the full amortization. I don't care if it's 300, 400 months, right? And I'm getting interest, principal out of each payment. It's a loan. It's always the same payment. And I'm getting balance, right? So I'm watching that balance go down. So what I look at as, say we're at $1 million, right? We'll do all the zeros for fun. So you're at $1 million. Remember, this is going down. You're watching it every month it drops. The interest is slowly decreasing. The principal is slowly increasing, all the way going out for 30 years, let's say. So, $1 million, pay $140,000. What's that get you? I go down to here. Basically, I just look down the side and I pick the number nearest, $860,000. Right? Still the same payment. That's not changing. It's a loan. Still a fixed payment, $860,000. Everything above that line, that's how much interest you just saved by that chunk. Right? This is exactly, I just did this, I think it was last weekend. We had the coaching call with them. That's how much interest you saved. Right? But it's not static. You've got 10 months, $4,800 before you work that $140,000, him, not you, him on his line of credit, back down to zero. Well, in the meantime, it's 10 months. So it doesn't matter. Say we're at month, we'll say we're at month, it's 140,000. We're at month 10. Well, that was month 10, so this is a month 11. This is the following month. So here's the 11-month mark, right? We're ready for our next chunk. Sorry, this is our first chunk. Boom, brings us down to here. 10 months, 140. In the 11th month, there's 860. We're now ready for another 140K, but we're not ready. We gotta go 10 months. So you go 12, 13, 14, right down to 21. That's interest you still pay. You got to keep making payments, making your payment on that loan until you're ready for your next chunk. So whatever it worked down to, let's say it worked down to 848, right? But now we went 10 months. We paid off that $140,000 chunk we made. It took us 10 months to bring that back, or his HELOC, his debt destroyer, back down to zero. In the meantime, that 10 months, this is interest you pay. This is paid interest. Right? I wish you could avoid it all. How awesome would that be? Well, we wouldn't be, I'm talking at you. We're not talking right now, but this wouldn't be happening, right? Boom. So we're at 21 months. The end of 20 months, 848. Boom. He locks back to his line of credit debt destroyers back to zero, make another $140,000 chunk. Now we're at 708. 708,000. Down here. Same thing. You jump ahead. You're going to jump ahead. Now in the beginning, it'll be a shorter jump because it's heavy interest in the beginning. Low principal. The payments work the same. What happens is you get towards the end. I'm sorry. The gap's always the same because it's a fixed payment. Your interest is what's going to change. Like I think his first 140 saved him 195,000 in interest. Then his second one was like 1,627 or something like that. And by the last one, his last chunk was 140, saved him, I think it was 27,000 in interest, 27 and change in interest. So it's gonna get less because your interest is dropping as you're making your payments, your principal is increasing. But now we're down at 708,000. This is interest saved, right? Because we just jumped ahead on the amortization schedule, right? And where were we? Well, 140 takes us however many months it takes us. It's simple math. Like say it was his payment was 5,000 a month. 5 times 14, 20, 70 payments. right? So it jumped 70 payments. But he just made this chunk down here. However many that is. I said 70 payments at 5,000. Is that right? Yeah, 5. No, that's not right. It's 28 payments. Wow. Sorry, 28 payments. So boom, we jumped 28 payments. We saved this chunk of interest. But now we're here. 10 more months. So we jumped way ahead, whatever it is. What did I say? 28 months later. So now we're at 49. We're at 49 months. Same thing. Now what is it? It's 10 more months to get to 59. And then the 60th month is obviously the start of the next month where you make the payment. But here, it's the same thing. That's paid. That's interest you got to pay. And that's how I get through it. And in the meantime, my calculations, your calculations, you're living this. It's much easier. My calculations, this is his big thing. I've got every other credit card, every other loan. So when he's down here, let's say, oh, I remember one was. At 17 months, one of his credit cards got paid off. Just making the same, it wasn't his the minimum payment, but making the same fixed payment. Credit card one got paid off. Well, what happened was, remember I said it earlier, I did hand notes. So I wrote 17 months, credit card one paid off, and I went, total expenses dropped $200. I said that was as available. So if you're, remember, I already erased it. Total income, total expenses, because he's using a line of credit. If his total expenses dropped $200, his available, his cash flow increases $200 because it's $200 less payments he has to make. So that went up to $7,200. Well, that accelerates this a little, which makes this closer together because now you're able to pay off that $140,000 chunk inside your line of credit doing the pay down strategy faster. And I got to do it each time. I got to pay attention. We keep going down. If it's a jump gap, I've got to stop it. Not a jump gap. I'm sorry. If it's in a payment gap where we're making the payments, I've got to stop it. And you had one down here too. You had one at, well, I remember you had one equal. I went to 49. Him was actually right at 48. So two things happened. He did a chunk and another card got paid. Oh, actually it was a loan got paid, a vehicle loan got paid off. And he does down here. So then I got to keep recalculating. I got a little deeper into the math than I wanted. But this, when you get full analysis, you get into Excel, you need it. Just think about all the programs there are for investing in the stock market. There are no programs for investing in your own personal finances. Well, you'd say I'm working on one, and I am working on one. But it's a little ways away. But basically, that's what you do. You're not a small business. That was one of the concepts. All small businesses is knowing your money in, your money out. But you work for a living, for like a paycheck. There's no go out and increase sales. There's no growing your business. You're fixed without getting a raise or changing jobs to get a raise, however it works out, or however you would work that out to increase your income. So you got to look at it not from an external view. Oh, treat yourself like, no, you are a bank. Bank. You want to make bank. You want to save bank. And you want to bank yourself. So you are paying yourself interest instead of the bank. It's just the actual bank, the real brick and mortar bank. It's just the only abstract part. It's not even an abstract part. The only problem is you got to enjoy adding up the dollar savings without ever actually seeing it in your account until the end. So what he did was this 400K was like 360 from sales, some assets he had, and then 40 he had to take out of his savings. I told him, he said he was willing to do some. He didn't want to do it all. He was running a successful business. He just wanted to get out of it. He didn't want to retire in a certain amount of time. Right? So that 40,000 came from savings. Remember, I think I touched on it earlier. It was in a different video. He had an 8-year plan. We got him to about 7.5 years. Well, he pulled that savings out 7.5 years. I believe this was savings, not an investment. Investment, it's hard to compare because you can't project. I can't estimate forward, neither can he, what someone would earn. It's an investment. There's no idea. But you can figure out what it saves you and how long it takes to pay back. Well, by the time we worked through, and that's literally how it went. His whole business model was this essentially worked down to just paying this $1 million loan off. In the meantime, every other credit card, every other loan got paid off as we worked through this for 7 years. So when he got to the end, remember, this is a company. This is his company side. This his positive cash flow up to like $16,800. So he wanted to retire at 8, at roughly 7.5. I got him to get all his debts cleared, but he took 40 out of his savings. If he goes one more year, 6 months past his goal, he's got another $100,000 in the bank. This is after tax money. It's not like he's got $100,000, plus he's got to pay taxes on it. No, that's his positive net cash flow. Because the only numbers we work with are your net, right? After you pay everything. So for him, and obviously it varies, right? There could be all kinds of crazy numbers. But yeah, he paid that back and a chunk of, what he would have loved to have been able to save and invest at the time. But yeah, so that $40,000 he took out 7 years ago, it'll take him 1 year to put $100,000 back into that account because he freed up all that cash flow. And it's going to work for you guys. The scales change. None of the principles change. That's why I said, not small business, not money in, money out, know where your money is going. No, you are a bank. It's about interest savings. It's about moving your money to save you interest. The only thing that can make it better is if I actually saved you interest and the dollar went into your pocket each time. I can only save you interest and keep that dollar from coming out today, tomorrow, 2 years in the future, however it longs, based on your budget, your current finances, and your debts. Again, I'm Dan, Pay Down Debt Solutions. Thank you for watching. Remember, always align, never alone. Thanks.